Brian, in the past, you've talked about the non-interest-bearing accounts, the deposits you have that you don't have to really pay interest on. I wonder about that. You seem to be doing a bit better than maybe your competition does. Do you have some pressure? Because as you see those rates go up, you must have some people, at least on the margin, saying, you know what, I can get some interest someplace.
And they did, and that's why our deposits have moved down. So if you think about our wealth management business, they probably peaked at 50, 60 billion higher, and a lot of that money moved to the market. And I heard in your last segment, our customers at Merrill Lynch are holding the highest amount of cash and treasuries and things that they've held, up $300 or $400 billion over the last couple of years, and that money is waiting to come back in the market when things stabilize. So, and that business happened. In the commercial business, you saw that go out, and then you saw it build back, and that's starting to grow again at the $500 billion level. In the consumer, the consumers that have investment cash that they don't need to conduct their day-to-day operations, they have moved that into the higher yielding savings accounts or even in the market. And so, if you look at the upper levels of deposit, average deposit balances in 50,000, 60,000 and above, those are actually down from the pre-pandemic. And the reason why is that money went in the market. It didn't disappear. They just moved it to other things. The core transaction base is coming in and out. The paycheck comes in every 2 weeks or every week or every month. It goes through, pays all the bills, and then comes in again. That is really hard to position because I position and my bills go through and I don't have the cash in the account. So it's a different business, and it's a business which we do for companies and wealthy people and consumers, but it's a big consumer business for us, and it continues to grow and grow well.
So Brian, you have such a vantage point into the consumers across the country, and you said that you're starting to see that slow some as we go into the end of the year. Do you have any expectations through the end of the year into 2024? Will it continue to slow?
So let's think about two or three things there. One is just what are the consumers doing with the money they have in their accounts? And in a given year, we will have $4 trillion that will be spent by our consumers on debit card, credit card purchases, Zelle payments, checks written, money out of the ATMs, and all the different forms they spend it. That $4 trillion from in 21 to 22 grew at 9%. Year to date, for the first 4 or 5 months of the year, I would have been telling you in the second quarter, it's still growing strong at like 8%. It's now down to 4 to 5% in the year to date, and about 4.5% in the month of September, and in the month of October, consistent with that. The consumer has been slowing down their spending because interest rates take a toll, because as rates went up on their floating rate loans, their home equity loans, or other things that float, credit cards, or frankly, new car purchases, the rates are higher. Though there are mortgages getting done, those rates are higher. That slows down the restart of student loans. All those slow down their ability to spend on other things. They have to shift spending around. And on top of that, frankly, they're looking ahead, say, hey, I hear things are going to be bouncing around a little bit. I'll spend a little less. And then the third thing is, they've taken, they bought the goods they bought during COVID. They bought the new couch and stuff. They don't need to buy another one now. They've taken the trips, and now they're back into their core activity. And so as you put all that together, it's slowed by half. And what is spending rate at the year-over-year growth is consistent with 2% inflation and below 2% GDP growth. It is the same, that rate of 4% or so is what we had in 17, 18, and 19 as the economy kind of ended into an equilibrium. So frankly, the Fed has won the battle with the American consumer, and they're slowing down. And then the question is, what happens next? I can't predict, but this is a $4 trillion base, $300 to $400 billion a month. So think about it. It's hard to move around a lot. So once it slows this level, it's probably not going to kick right back up.